Good morning and welcome to the second session of Chapter 4, the theory of firm under perfect competition. Now, as we were discussing in the previous class, what are the factors that leads to a perfect competition, which means to say that you are in a balanced market where there are equal number of buyers and equal number of sellers. Now, in this class, we are going to take the concepts to the next level. So, we are going to learn about average revenue, marginal revenue, and various other factors that leads to the profit maximization curve. So, in this class, our primary objective is to understand how does the firm make profit under a given condition. So, going forward, the first thing that we are going to learn today is average revenue. As I have told you, the word average is a very important concept when it comes to our day-to-day life. And economics is no special case at all. Even in economics, average holds a very important place. So what is this average revenue? Average revenue is defined as total revenue divided by quantity. So total revenue divided by quantity will give you the average revenue. So for example, if an industry, let us take that industry as Nestle or Cadbury's or Asian Paints or Reliance, whichever industry you want to take as an example, they have something to produce on a day-to-day basis. So they will be producing their output on a target basis. So every day when they produce, they are trying to generate some revenue, because that product which is manufactured out of the firm, out of the factory, will go to the market and they will make some revenue out of it. So the total revenue is a factor or is a combination of all the products that is produced and that is going to the market to be sold. So the total revenue here will indicate the total money, the total income that is being earned by the company by making the sales. So what is the quantity which you are selling? Now for example, Nestle India Limited. Nestle manufactures 1 lakh packets of Maggi and they sell it in the market. Now the cost of 1 lakh packet of Maggi, let us try to calculate. If the cost of 1 packet of Maggi is 10 rupees for example, so now Nestle would be manufacturing 1 lakh packets. 1 lakh packets multiplied into 10. So the total revenue that would be earned by Nestle will be equal to 10 lakhs in a day. So now how did this 10 lakhs arrive? The 10 lakhs arrived by the total revenue divided by the quantity. So the total revenue is 10 lakhs. 10 lakhs when you divided by the quantity, that is 1 lakh, you get the average revenue. So average revenue at any given instance will make you understand what is the money, the income that is earned by the company at any given instance, at any given point of time. On an average basis, what is the revenue that is earned by the company? And this is very important. Why? From the economic standpoint and also from the financial standpoint, if anybody wants to assess a firm's manufacturing capability, the financial capability, the output capability, average revenue will play a very important place there. So anytime when the analysts look into the company on an average basis, they want to understand how much money, how much income a company is able to make on a daily basis, a monthly basis, or on an annual basis. So keep in mind, average revenue is nothing but total revenue divided by the quantity. Now moving forward, marginal revenue. This word margin is very important. Why this is important? Any business, as I have told, has the tendency to get more and more. So today if I have made 500 rupees as profit, will I be happy with this 500 rupees? Definitely not. I want more. So I want to see whether I can increase this 500 to 1000 rupees in a day. How can I increase it to 1000 rupees? Can I just start producing more and more? Or can I just start increasing my sales? Or can I increase my price? Different factors come into my mind. But on a reality basis, the marginal revenue can be attained by change in total revenue divided by change in quantity. So the change in total revenue, that is from 500 to 1000, when I increase my revenue target, that will happen by change in quantity. So there is a slight change, there is a modification, there is an increase in the output altogether. So when that happens, automatically the marginal revenue goes up. I go up by a margin. I am not saying that I am going on an absolute percentage. I am going up by a margin. One by one, little by little, I will start increasing. And this matters a lot, because when you are in a manufacturing company, you will try to understand on a daily basis, margins do matter, because in the long run, all this marginal cost, marginal revenue that you are able to get will add up to your revenue going forward. Now we are going to see the factors of profit maximization. As an industry owner, you will always be interested to understand what are the factors that make me earn profit. So there are many factors. When you talk from a business standpoint, there are many factors. But when you talk from an economic standpoint, there are three major factors that you need to understand in terms of profit maximization. Now the first one, price must be equal to marginal costs. Now that is very, very important. Price must be equal to marginal cost. Now why that must be equal to marginal cost? Whatever you are trying to price a product today in the market, the marginal cost should also be included, which means you cannot have a separate margin factor and a separate price. The price should be able to take the marginal factors inside and then do it above. So which means the first factor itself, you are figuring your marginal cost inside your MRP, inside your maximum retail price. So your price should be inclusive, should include and should be including the marginal cost factor altogether. Then only when you price it in the market, the first level of profit is attained. The second one, marginal cost must be non-decreasing. This is very, very important. Now if your marginal cost starts declining over a period of time, let's say for an example, you have started manufacturing and you start finding that your margins are coming down. The marginal cost has started dipping. Now what is going to happen because of that is you are going to produce a flat product. A product without much of variations. You will be just producing only one kind of product. Now when you start producing one kind of product and start selling it in the market without variations, without any variable control on that, automatically the number of buyers will start coming down. Now that will lead to a problem. Why? Because your marginal cost will start coming down and you will be just manufacturing only one kind of product, which means the extra revenue cannot be made at any point of time. So the second condition for profit maximization is that marginal cost must be non-decreasing. It should not go down. It should continue to maintain at a particular level and keep moving forward. Then we will be able to see profit coming up. The next factor that we need to discuss is price must be greater than the average variable cost or the average variable factor. Now why this is important? On a general basis, let's try to understand this with a simple example. Now if you are going to manufacture a chocolate, the chocolate will have all kinds of factors to be taken into it. Now it will have something called as manufacturing cost, packaging cost, labor cost, branding cost, labeling cost. So many factors come into a manufacture of a chocolate. So when you are doing this business, you will try to understand if you are going to fix the price of chocolate as rupees 10 per unit, that rupees 10 should be inclusive of all and should have a margin above, which means it includes all your variable costs and then you have priced it above. So that means there should be at least 1 rupee that you are making a profit by manufacturing that small piece of chocolate. Suppose you are going to price that chocolate at a value which is below average variable cost. That means you will not be even able to recover the basic cost that has been utilized in manufacturing that chocolate. So our primary intention in mind should be kept that price must always be greater than the average variable cost. If the price becomes lower than the average variable cost, automatically that will lead to a shutdown point or that will lead to a non-profit condition. So going back, let's try to understand what are the three factors. Price must be equal to marginal cost. At any given point of time, marginal cost must not be decreasing. And the third factor, price must be greater than the average variable cost. So keeping these three factors in mind, this is very, very important because even from an exam standpoint, there will be a question that will be asked, what are the factors that lead to profit maximization? So you need to write these 3 points to score marks. Keeping this in mind, let us see the graph that relates to the profit maximization. If you look at this graph, it's quite interesting to understand. The underlined area is called as profit. Now there are two factors. You have the price and you have the competitive price. So there are two factors that come here. One is the price, the other one is the competitive pricing. Now if you look at this graph, you will be able to see that over a period of time, when the marginal cost, the average cost and the average variable cost are set across, which means as per the profit maximization condition. The three conditions that we told, price must be equal to the marginal cost. Marginal cost should not be declining, it should be going up. So in the graph you can see very clearly that the marginal cost is continuously going up, it is not decreasing. And the most important thing, the price should be greater than the average variable cost. So automatically when the price factor is above the average variable cost, you start attaining a profit situation. Now this profit is very, very important in economics. Why? Because apart from the graph factor, if you just have to understand it from a layman's standpoint, you should always keep in mind all the cost factors included plus a margin above it will lead you to profit. So that is what we try to depict here graphically. We are trying to say that keeping all the cost at a particular level, the price should exceed that cost. The price should go above the cost, which includes your marginal, your average cost, your variable cost and all those factors, and it should go above it. So when you are able to manage all your cost and take it forward and sell it at an appropriate price in the market to the consumers, then automatically you are moving towards a profit maximization situation. Moving forward. In the next graph, we have the factors, conditions for profit maximization. Now, what are the conditions? Sir, we have seen these conditions in the first half itself, where we had spoken about the three terminologies, where we spoke about price being equal, the marginal cost not decreasing, and keeping it above the average variable cost. So what is that special that we are going to look here? The most important thing that in this graph you would start seeing that there are various quantities that are being produced starting from Q1, Q2, Q3, Q4 and Q5. So there are 5 levels at which the quantity, that is the output, is going to be produced. So if I am going to produce a quantity Q1, you would see that the quantity Q1, the graph is coming downwards. In Q2, I am trying to increase. Q3, I am trying to go up. Q4, I have gone above the level, and Q5 is above, way higher. Now, what is happening here is that Symbolically, I am trying to say that the marginal cost is trying to come down in the factors of Q1 and Q2. But by the time I reach Q4 and Q5, the marginal cost is also significantly going up if you observe in the graph. So as per our condition number 2 in profit maximization, at any given point of time, the marginal cost must be non-decreasing. It should not come down. So if it comes down in this area, if it comes down, then we are not making profit. But in this area, when the marginal cost is going up, if you see in the graph, there is a situation where the marginal cost is going up. That is the point at which we are again going to profit maximization. So the point Q4 and Q5, when the marginal cost is going up, the arrow mark starts indicating towards an upward journey. Marginal cost is going up. That is the point at which we have started making profit. So our conditions of profit maximization, at any given point of time, the marginal cost cannot dip downwards. It has to continuously take an upward journey. Moving on, the next condition that we are going to see here is the price and average variable cost relationship with profit maximization. As I have told you, the relationship of price and average variable cost. Now for this, let me take a very simple example of manufacturing a pen, or manufacturing a pencil box, or manufacturing a watch. Now if you take any of the small scale industries altogether, they have a very simple cost called as the average variable cost, because there are very small components that are included, and each of those small minute components will have their own cost factor. So when they are going to price a product in the market, let's say that I am manufacturing a pen and I am going to place that pen at 10 rupees in the market. Now when I place that price as rupees 10 in the market, what is happening is that this 10 rupees is a combination of my average variable cost, which means to say that it includes all the factors that are there in terms of manufacturing that particular pen. So it becomes very important for us that we include all the component prices, all the variability. Now what are all the variability? That might be the design, that might be the color, the packaging, the way it is branded, the way it is labeled. All those small costs should be included when we are going to take that product to the market. So you cannot identify it as separate components. It's a package. It is one single unit which is going to be priced at rupees 10. But that 10 rupees internally is divided with all the factors put together. So at any given point of time, this 10 rupees indicates for a company a profit value. It does not indicate just the cost value. It indicates a profit value. Bearing all the cost in my mind, I am going to sell the pen at 10 rupees so that I will be able to achieve some profit. So in that condition, what is very important for me, if you look at this graph, in this graph we have taken two important factors altogether. We are going to talk about the short run marginal cost, the short run average cost, and we are also going to talk about the average variable cost. At any given point of time, let's say that even if you are going to give the price lower, for an example, you want to run as a market penetration test, you just want to make the pen available at the market even at the cheapest price possible. You cannot bring the price lower than the average variable cost, because if you sell your product lesser than the average variable cost, the arrow mark comes down below the average variable cost, then you are landing up in a loss. You are landing up in a shutdown point altogether. So the curve says that whatever factor, when you are in a short run especially, whatever product you are manufacturing, you cannot bring the cost below the average variable cost. You have to keep the price above the average variable cost, which means you include all the factors and you price the product in such a manner that when you sell it in the market, it sells at a price where you are able to take all the costs together and move forward. So at any given point of time, tomorrow in any of the manufacturing industry, when you read through, you will try to understand that keeping all the cost factors inside, they would fix a price in such a way that they are at least able to come to a break even as soon as possible. So that is the relationship that we are talking about, price average variable cost relationship with profit maximization. Moving forward. Now, price must be greater than or equal to average cost in the long run. Now, moving further from the short run, now when we move to the long run, we have a different mindset altogether. Why? What is that different mindset that we need to talk about? Now, in the long run, we know that we are capable of taking any kind of cost, because I'm not going to run the industry for 6 months or 1 year. I'm going to run this industry for years to come. So in that condition, what happens for me? I am ready to take the cost. It might be an average cost, it might be a variable factors, it might be environmental factors. I'm ready to take the cost. I'm ready to make a price in such a way so that I can take it forward and I can start making profit for years to come. In that condition, we have two factors: long run marginal cost, long run average cost. So when you are manufacturing something, it will have marginal cost and there will be an average cost. On an average basis, though you have been in the industry for 10 years, 20, 30 or 50 years, there is some average cost that keeps on happening. So that will be represented by the curve here, which keeps floating around. So that will be an average cost. On an average basis, you see the cost that is floating, and then the marginal cost will tend to rise because you are trying to vary your products over a period of time. So it will keep on increasing. But what is the condition that we need to keep in the mind? We need to keep in mind that it should be greater than or equal to average cost. At any given point of time, your price, the product price that you are going to sell in the market, should be greater than the average cost. It should not come down. You should not go to a position, since sales is not happening, sir, I will reduce my price below the average cost, then automatically you will suffer loss. So at any given point of time, whatever product you are manufacturing, you cannot come down below the average cost. You have to keep your product floating upwards. It has to be greater than the average cost altogether. So when you look into manufacturing companies like automobiles, for example, since the sales is not happening, they cannot sell the car for free, or they cannot make the car price come down more than 50% lesser. They have to maintain an average cost for every single version that they are coming in, and then they will sell the car at a particular price. You might see that there are discount offers that are being offered to you in malls, in any of the products that you are taking, but all those discount prices will be kept in mind with the average cost, and then they will price it strategically so that the company does not loses the profit completely. They know that for the consumer there needs to be some attractive proposition in terms of pricing. But at the same time, the company will also be cautious enough that they don't make the price fall down so much that they will fall into loss. They will keep the average cost in mind and they will not go below the average cost. They will always keep the price at a level above the average cost so that both the company and the consumer are benefited in the long run. With this, I would like to conclude today's session, and I hope and I believe that you have enjoyed this session and you have tried to understand something about the average revenue and the short run marginal cost. In the next session, we shall be trying to understand the different factors coming across the short run supply and the long run supply curves and the marginal cost in the next session of chapter 4. Till then, a warm thank you from my side. Please stay tuned for the next session. Keep learning and keep enlightened. Thank you very much.